CEO and co-founder of Lanes and Planes. We're a digital travel management company based in Munich, Germany. We DN portfolio company, joined in the Series A, and happy to share my experience in a minute about easy peasy times of raising Series B last year.
Hi everyone, I'm Zoe. I was just asked if Noteos is a portfolio company of DN Capital, which is obviously a big compliment, not yet. But I'm basically also a founder. I'm one of the co-founders and general partners of a new growth equity fund, which is called Noteos. You might or might not yet have heard about it. We started earlier this year, have invested over 300 million already, really with that core thesis of investing across Europe. We have an office in Berlin, London and Paris, opening up Madrid with that core thesis of backing European-born category leaders as early as possible, but really throughout their journey. And it's obviously very exciting to be speaking to you all about growth equity and learning a lot from the founders also on this stage.
Hi everyone, it's Raluca, and we're all defined by the last best thing we've done. And the last best thing I've done is invest and lead the Series C for Philip at Cognigy. So I'm here merely as his investor, and otherwise I lead the UK and the DACH business for Eurazeo Growth, and I've been spending time investing in growth stage capitals since 2007, and I've seen more ups and more downs than probably more people have been around. So happy to share more lessons than anything else.
Yeah, I'm Michael. I'm happy to be here. I'm a lawyer with Pöllert, one of the sponsors here. And our law firm is focusing on transaction fund formation and other legal things. And I'm happy to share here my views with you.
Hi everyone, it's me again. I'm Phil, the founder and CEO of Cognigy. I'll join every panel from now on.
We can't keep Phil away from the stage. Maybe let's kick off with a question more focused at the founders. You've both raised super successful growth equity rounds in the last 12 months. Maybe you could give the people in the audience a little bit of an insight into how you prepared for that round, and maybe, obviously your rounds were very successful, but tell people what you would do differently if you were doing it again today.
So I think that it's important for you to know there's a little bit of a background story for us. So as I said, we're a corporate travel management company, and there used to be a time when people were not traveling. Some of you might remember that thing called COVID. And we were lucky enough that coming out of COVID, our existing investors believed in us, were backing us, so we had the opportunity to grow and not go out instantly raise money. But what we saw, raising a Series B was crucial for us taking the next step. But we all know how the environment was last year. But we were growing, and at the same time, I actually needed to focus on fundraising. So the discussion we had on the board, so what's the best impact I can actually deliver? Is it being on the ground, being with the company, or is it going to be, let's be frank, 6 months doing nothing but just not being in the company and being operational? And so we decided to work with an investment bank. I think for us that was really helpful. I know I was personally very hesitant to do that, but in the end it turned out to be the right decision because it really funneled the discussions and appointments I had. And in the end it turned out to, we ended up with a investor from the East Coast that we probably wouldn't have on the radar.
Yeah, so we just recently raised our Series C round. Thanks, Raluca, for closing that with us. And I think the biggest difference for me compared to the other rounds before, also in terms of preparation, was that, of course, if you raise a seed round, it's all about vision, right? And oftentimes you only have a PowerPoint, and then on the Series A you have some customer validation, but it's also mostly about vision. And we discussed it prior to this meeting here today, and I said, yeah, it's becoming less and less about vision, but in the discussions with Guy, I've changed my mind a little bit. It's actually, I think you used the words, metrics get you through the door, and vision is what closes the deal in the end. And especially the metrics portion, I think, should not be underestimated. When you get into the Series C round, it's very technical, right? You need to have all these KPIs and measures, and you need to be able to back them up. So your financial systems need to be in order. You need to have a lot of processes in order. That is probably not so necessary when you raise an A round, or definitely not a seed round, right? And so this was our Series C. So being very well prepared, I think, is the key. Having the metrics in order, also having the metrics historically in order, and showing the right directionality in those metrics, I think it's very important. And is something that maybe a lot of founders that are more used to the vision and the pitching that I did just now initially isn't something that comes to mind, right? But then again, of course, once you are through the door, outlining a clear vision for the future, exciting people, because we're not talking about 200,000 euros that are getting invested, but a little bit more. And if other people who have worked for this money give it up to you, give it to your company to then actually grow it, there needs to be a lot of trust, and in the end I think it's that. And that's what I enjoyed in the process. We actually spent a lot of time face to face, right? Getting to know each other, not just us, but also the teams. And because you are entering a relationship that will last for quite a while, and you need to know that you're doing that with someone that you trust and that you believe will help you on your journey, because I know it's touted so often, but I think it really rings true. It's not just about the money. There's a lot of money in the market at the moment, which is being deployed very carefully, right? But there's a lot of money available. But you really want to be funded by someone who can actually help you on your way, and I think we have found that with you.
That's a great...
One quick thing about the metrics.
Yeah, absolutely.
I'm just going to budge in, because I think what's really important is that you understand as a founder, not that you have the metrics, but you understand the why of those metrics. Why did actually something happen in a certain way, and not about a particular one little account and why they churned, but to actually raise it one level and understand the trends and be able to explain. And I think what happened here was every time we asked the question, he was able to unpack the why. Did this happen? Why is this happening in the business? So knowing your business and being able to look from the outside in at your own business and to decompose and break down the Lego pieces that make up the trends.
I think Phil raises a really interesting question there around when you get to these later stages of fundraising where things can appear a bit more technical. I'd love to hear how you both think about that relative trade-off between the importance of metrics and the importance of having a story and a vision to back that up. Because it always occurs to me that when you buy a share in a business, we don't really think about it as we're buying a share of some future cash flow. You're really buying into a story. So would love to get your perspectives on how you think about the relative importance of financial performance and story.
Yeah, sure. I mean, I think it's a great question. I thought about it before, and now listening to you actually will correct my thinking about it, because you're right? You have the right KPIs, and that's basically a hygiene factor, as we say in German, right? That gets you to people actually spending time looking at your business, hopefully coming up with a valuation that you kind of find attractive. But then we investors, we spend a lot of time thinking about not only the equity story of the business today, but truly the equity story 4 or 5, depending on the stage, 6, 7 years down the road. And in growth stage, it's relatively short. It's maybe 4 or 5 years, and we do have to understand that. And this is where the vision piece becomes important again. It's about understanding if somebody has the vision to, and now it becomes again a KPI, to expand their addressable market and how to go about it, because you really want to see that continued growth, and that goes through expansion with your existing customers. To your point, understanding, where does your net retention rate stand today? But then investing in products so that you can actually drive upsell, not just by selling more seats, but fundamentally by offering better products to more of your customers down the road. So I think this is super interesting for us to spend a lot of time with founders on to really understand that vision and frankly gain a lot of comfort on that. We love to invest in founder-led businesses that remain founder-led for a very long period of time. We've made really good experiences over the past 30 plus investments we've made. And so this becomes a core factor for us and it never stops. So I think the vision really comes up again. And then the other point I would say is that focus on relentless love for your product and that focus on product and obviously also the same for your customers. And this is something where I tend to get very excited when I see a founder, truly spending time on the continued issues, challenges that customers face, and finding new ways to address them. And this never stops. Even if you're at 250 million ARR, which is something that we see not often, but we tend to invest quite a lot of our money in companies at these stages. We want them to continue to think about this and invest heavily into R&D and in product to be able to sustain growth over a longer period of time. So it's really both. But we're definitely in a market where a lot of the companies have to show very good financials for people to even spend time, and that's one of the biggest risk factors I see. Maybe that's actually helpful for the founders in this room, is that you're going out at a point in time where you're in a weak position from a numbers perspective. This is like not a good market to do these kind of experiments.
I'm sure everyone in the room agrees with that. I don't think there's ever a good time to go and raise a growth equity round with bad numbers. Just maybe to Raluca and to Michael, who you're seeing growth deals coming through on both the legal side and as an investor. What are your perspectives on the outlook for the next kind of 12 to 24 months? Because we've had quite a roller coaster ride in the growth equity markets through 2021 to 2023. What's your take for the next 12 to 24?
I would say that we're in an interesting moment because it feels like this should be a very good vintage. But it's not actually clear that it's going to turn out like that. That's because I think we have quite a few things at play right now. So clearly the first thing is the bar went higher for the types of businesses we're looking at. Back to the metrics, right? The same metrics that we have gotten you in the door in 21 are not the same metrics that get you in the door in 24. So that bar has gone up for everybody. And that basically leaves quite a few companies behind, or they have to compromise on something they're doing in their internal rounds, or they're not going to get funded, et cetera. But even for those that are coming into the door, you'd actually think people understand that there's math about valuations, and if your exit valuation that you're now embedding is going to be more reasonable, it's going to be very hard to pay a high one up front. So that's kind of understood by the investors. So you would have actually thought that it's going to be a fantastic vintage because you're going to get better businesses priced better. But actually what's happening is a lot of funds raised a lot of money right prior to these kind of, let's say, resetting of mentality. And in growth, I would say most growth funds last year barely did any deals, if any. So you actually have this glut of capital. So the moment there's actually a decent company on the block, there's just exceptional competition for it. So actually either processes are again getting shorter or valuations are actually not as they're better than they used to be in 21, but they're not amazing, right, where it's a clear home run. So I think it's we're in an interesting moment right now where people are potentially a little bit pressed for deployment in 24. So we're seeing a lot of growth funds, especially a lot of VCs that have raised growth funds who are not growth specialists, play in names where actually the bar is becoming lower, again in quality, but they need to deploy. And maybe after this cycle's out, so maybe we need another 12 months, we're going to actually have a more reset. So I guess that's my view, at least, that I think it's not this kind of very obvious reset where we're all going to get these incredibly kind of well-priced, exceptional companies, because I think there's a lot of capital out there.
Add something to it, and then I'll let you obviously comment from kind of the legal perspective as well. I think what I've observed is that there's just these different market segments, and you might have seen the same, where you see like early growth between like 10 and 30 million, maybe top line, priced much more aggressively, inherently because of the level of competition you mentioned, right? Both from VC turns, growth investors, but also a lot of US funds coming in, really playing very actively there. And then the more you move up into the more later stage and the closer you are to exit, I think the more price discipline you get. And I do think that there's more limited capital available there and ability to price better. but you have to be hyper sure about execution just because you have such a short period of time to get it right and to repair. And obviously you have to get in at the right valuation because you can't make any mistake or assumption on some kind of multiple expansion or any of these kind of things. So I think it depends on a market segment, but I do think that like higher end growth segment is super interesting right now.
And maybe, Michael, you could just touch on how
Perhaps I
funds
can add here something. I tend to agree and to disagree in some ways. There is a lot of money in the market, but of course the market, from my experience, suffered a big crisis, which I would say, I tend to say, comparable to the dot-com crisis 20 years ago. The only difference is that there is more money in the market, there are more players in the market, and there are much more young companies in the market. So I think the field is a little bit different. In one way, it's very important, and this is what I tend to agree to Philip, is you need to be well prepared, you need a vision. And the vision gives you the entrance card to get attraction to the investors. And then, speaking on growth capital, because everything which is early stage, they are suffering. They are suffering in valuation, they are suffering in conditions, they are suffering in everything to get even €1 or dollar. Growth capital with a vision gets money because money is in the market, but then KPI beats the vision. You need the KPIs, you need to be in some ways to get your investor shown or evidence for your investor that everything which is invested you can pay back with a multiple of 3. Otherwise, and even more, at least.
Minimum.
And that's the
minimum.
That's
because LPs hold you accountable for
Forex. And if you can't show this, you don't get the money. And that's why I'm saying KPI is beating vision.
Michael, on this point, are you seeing growth investors put more structure into deals to underwrite and guarantee those returns? And at Zoe,